Well, greetings, everybody. This is Brian Davis with Independent IRA. Today is Tuesday, September 12th, noon Pacific time. I want to thank you all that are signing in right now to join our webinar today, for taking time out of your busy schedules to listen to our recourse loans with self-directed retirement accounts. And today I'm very happy to have Jason Zook of North American Savings Bank, a senior loan consultant who's done probably, and I believe Jason can tell me if this is true, more non-recourse loans for self-directed IRAs than anybody in the country in the last 13 plus years. So Jason, if you're there, say hi and thanks for coming on the webinar today.
Yeah, definitely. Thanks for having me, Brian. And you are correct. I have done more of these than anybody else that you'll find out there. So we are very familiar with how to get these done.
Well, great. I'm happy to have you. A little administrative work here before we get going. All the attendees, you guys are all on mute. If you have any questions, you can write them in the chat section, or you can go to the question section and write in a question and I'll get to your answers. I will be speaking for approximately 15 minutes here, kind of on the basics of self-directed IRAs and solo 401ks, and then I'll turn it over to Jason to get into a little bit more depth on the non-recourse loans, how they work, and some of the guidelines there with North American Savings Bank. So before I get too far, most of you guys know me as either Independent IRA or working with AccuPlan. Independent IRA is just my self-promotion. I'm an independent agent with AccuPlan Benefit Services, and I also set up checkbook IRAs, the retirement checkbook as well. One thing I do not do is provide any investment advice. Please consult your financial professionals before moving forward with any type of investment. All right, now that's out of the way, let's really get started. So self-directed IRAs, I assume most of you know what that is, but I work with AccuPlan and their custodian, American Estate and Trust, to provide a self-directed IRA administration. And we also have a solo 401k product. We've had that trust company now for 10 years. I've been with them for about 5.5 years now. And I've been in the self-directed IRA space since 2009. Prior to that, I was mostly doing real estate loans here in Southern California, San Diego County specifically. But 2007 happened and things changed, and I was happy to get the opportunity in 2009 in this self-directed IRA space. And I've opened up well over 1,000 of these IRA accounts and deal with thousands and thousands of transactions. And really excited to have Jason on the line today to highlight using leverage with your self-directed retirement plan. So for those of you that don't know too much about self-directed IRAs, you're not alone. It is a growing space, however. A lot of attorneys and accountants, they know a little bit about it, but they don't know everything. So you need to find somebody like myself that works with a custodian that will hold these investments that can help guide you through the process. And that's what's different about us, is we'll hold these things outside of the stock market that the brokerage accounts and the banks don't want to hold inside an IRA. So as this shows you, there was over $7.2 trillion in IRA assets at the year of 2014, and that number just keeps growing and growing. The stock market's been doing well, but only less than 5% of that is in a self-directed vehicle that can hold these non-publicly traded investments. So there's a lot of space here for growth in this industry. And I used to, when I first started doing these presentations back in 2009, these numbers were about 1 or 2% out of about $4.5 trillion in IRA assets. So you can see it's a growing space, and hopefully I'll have some updated numbers later this year. These are the main asset classes that we see in self-directed IRAs: real estate, investments in precious metals, private notes and loans, and investments into private companies. So that's just the main asset classes that we see. But you can invest in just about anything, as this next slide shows. You can invest in trust deeds, tax liens, raw land, oil and gas, water rights. This list could go on and on and on. The IRS, when making these guidelines, never created a list of acceptable investments. They really just talked about what you couldn't invest in. They really listed two things: what the IRS deems as a collectible, which you can see from this list here, or life insurance. And the IRS even made some distinctions between precious metals and coins and added them to the list of things that you could invest in. Now, a lot of times you'll also hear S corps, that IRAs can't invest in S corps, and that is true, and that is a rule of S corps that don't allow IRAs to be members. So that's what the IRS says, but that's not entirely everything. There's also something called prohibited transactions. So besides those things we just discussed, there are things that the IRS considers a prohibited transaction in your IRA. And that's when your IRA gets involved with who they consider a disqualified person. So this list here helps some examples of that. A disqualified person, you want to think about yourself, your spouse, and then kind of a lineal ascension and descension up and down. So parents, grandparents, kids and their spouses, grandkids and their spouses are disqualified persons from your IRA and can't come into contact with your IRA. And you also see companies in which one of those disqualified persons is owner or some type of officer position. And if you want to see any more light reading on this subject, you can look at Internal Revenue Code 4975 for a little more in-depth definition on that. So what happens if your IRA gets involved with one of these disqualified persons and you get a prohibited transaction in place? Well, the IRS can go in and as of January 1st of the year that the transaction took place, they can disqualify your IRA. And if that is in a pre-tax retirement vehicle, there's going to be obviously some back taxes for the year that happened. So you really don't want to get involved with a prohibited transaction. So we'll play a little game. Everybody probably remembers Deal or No Deal from probably about 10 years ago now on NBC. But we'll play it along with these prohibited transaction rules. So could your IRA lend yourself $10,000? Would that be a deal or no deal? That would be no deal. That is self-dealing. You can't loan yourself money. You're a disqualified person from your IRA. What about your brother? Could your IRA lend your brother $10,000? Deal or no deal? That one, surprisingly, is deal. You might not want to lend your brother $10,000, but your brother wouldn't be on the list of people that's considered disqualified. One thing to look for in this situation, though, is you can't just lend your brother $10,000 and then that money goes right back to one of those disqualified persons. The IRS looks at that as what they call the indirect rule. So if you're just trying to skirt your way around one of these rules by adding an extra layer by lending to a non-disqualified person, that's not going to work either. Now here's a little more complicated one. Could your IRA lend your stepson $10,000? Deal or no deal? Surprisingly, that one's deal. If it was your son, it would be no deal, but stepson, according to the IRS, isn't necessarily a disqualified person. Last one here before we move on, your daughter-in-law. Could your IRA lend your daughter-in-law $10,000? And that one is no deal. Children and their spouses. So you see it can get a little complicated, and that's why working with a self-directed professional like myself can help you not get into these situations and put your IRA at any potential damage. So let's get to the more fun stuff. How do we get started with the self-directed IRA? Well, you can put money in your self-directed IRA through three main ways, any IRA. So self-directed is really a marketing term showing that you're picking your investments in these alternative investments. But we have traditional IRAs, Roth IRAs, SEP IRAs, like any of the brokerage houses and banks. The first way to do it is if you have another IRA, you do what's called a trustee-to-trustee transfer. So we move cash from a different IRA over to an IRA with a custodian like ours, and there's no tax implications for doing so, and you can do that on unlimited time per year. The second way would be doing what's called a direct rollover. So most of the time this comes in the form of somebody has an old 401k type plan. And what you would do at that point is tell your administrator, I want to do a rollover to my IRA. You give that plan administrator your IRA information, and they'll write a check over to your IRA to deposit into the account. What you don't want to do in this situation is take those funds directly out of a qualified plan to yourself in your own name, because the administrator will take a 20% federal withholding out of it that you're not going to get back. So you want to make sure that you do what's called a direct rollover, not an indirect rollover. And then finally, the last way to put money into an IRA is through the form of an annual contribution. Most people follow the steps of having a traditional or a Roth IRA, where you are limited to $5,500 each year. If you're over the age of 50, you can throw in an extra $1,000 to those. And then we start looking at kind of the employer IRAs. A simple plan is very similar to a 401k plan, but the contribution limits are a lot lower. You can see here $12,500, and then the company match is rather insignificant. I don't see too many simple plans. I do see more of the SEP IRA plans and the individual K or solo 401k. A SEP plan is a self-employed pension. It works just like a traditional IRA, but it's for the self-employed individuals and perhaps their employees, where they can contribute to the plan, depending on how they're set up, 20 to 25% of their gross income, with a cap at $54,000 a year. And I also have listed here the individual K or solo 401k. I'll get into more depth about that in a minute, but that's for the self-employed individual that doesn't have any full-time W-2 employees, and it allows them to invest up to $54,000 a year total. If they're over 50, that number can grow to 60, and I'll get into more detail about the solo 401k in a second. But we make it really easy at AccuPlan to open up IRAs with us. Online link, so you can open up your account online. Then we'll work on funding the account as the methods we discussed, and this is the longest part of the process, generally speaking. It can take anywhere from a couple days to a few weeks to get the money from wherever it currently is sitting over to the IRA with us. So keep that in mind, especially if you have an investment that you want to get to relatively quickly. And then you can fund the investment with a direction of investment form and the corresponding documents, and that asset will be in your account online. Well, one of the main questions, and this is a topic we're going to be talking about more today with Jason, is, all right, I'm looking to buy some real estate, but I don't have enough money in my account to buy it outright. What can I do? Well, one thing you could do is you can partner with yourself or your spouse or a number of other people as tenants in common to purchase the property. The key to partnering, as the shows here, is splitting income and expenses in the pro rata share you purchase it for. So if you're buying a property, let's say for $100,000, you use $70,000 your IRA money, you find a partner to do the other 30%. Those percentages are set at that 70-30, using my example, and need to be maintained throughout. And backing myself up here, I know I talked about prohibited transactions and disqualified persons, but yet I said you can partner with yourself or others. The IRS has kind of come to the conclusion, if you start a transaction with yourself or another disqualified person from the beginning, that is acceptable. You can't come in later, or your spouse can't come in later and come in as a partner. But if they start the transaction from the very beginning, they can partner with each other. It gets a little complex, in my opinion, but it can be done, and I have a lot of clients that do it. Now, the main thing we're going to talk about today, which Jason will go into more detail, is you can borrow money from a non-recourse lender. North American Savings Bank is the largest of these non-recourse lenders in the country, and as Jason mentioned, he's done more loans than anybody over there. So with that, the IRA makes the payments. The only thing you need to worry about is there's a potential tax to your IRA based off the percentage of debt financing you use. So for that example I gave earlier, you have $70,000 and you get a loan for $30,000 in that $100,000 purchase. 30% of that transaction is leveraged. This tax law says then 30% of your net proceeds are subject to a tax. So it's net proceeds, so you can write things off like depreciation and other things, but please consult with your tax advisors before moving forward, so you know what you're getting into. in regards to the leverage funds. But it's a good way to go, and it still going to make more sense than partnering with a third party. You'll make more money doing it with leverage still. And one thing to mention, if you have a solo 401k, you're exempt from that specific tax. So that's another thing to look at, and I'll get to that in a second. So my kind of last part here of my presentation is talking about the checkbook IRA and the solo 401k. So in the 90s, there was a tax case called the Swanson case, if anybody wants to Google it, and it was in the mid-90s. And this guy Swanson started a couple of companies and funded them with his IRA and made himself kind of an unpaid manager of that entity. And the IRS first said, oh, it's a prohibited transaction, and they took him to court. And the court basically came out and said, well, since he's not paying himself any interest or any money as a manager of the corporations, that this is allowed. So that set up the scenario where people could create these entities that their IRAs own that they could run to get into the transactions themselves, which can save time depending on the transaction of not having to go through the custodian for every piece. Now, most of the time out there, people are doing this using an IRA LLC. In this scenario, the IRA is the member and the IRA owner is the manager. Now, one thing I'm here in California that we see a lot of is the franchise tax board. They're going to want their piece here, which is they want at least $800 a year plus any type of gross receipts tax if you have gross receipts over $250,000, which is why I work with the retirement checkbook, which utilizes a business trust instead of an LLC as the entity structure. And the great thing about this is on the state side, it follows the federal guidelines. So if it's a pass-through entity on the federal status, just like the LLC, well, in this case, the franchise tax board, it's also a disregarded entity and doesn't have to worry about paying those franchise tax board fees. So if you want any more information on that, please contact me offline or check out my website at retirementcheckbook.com. I kind of went into this already. The solo 401k I talked about. So it's a 401k plan for the self-employed individual that doesn't have any full-time W-2 employees. So people can create these, whether they're 1099, LLC, corporation, and set up their own 401k plan. People can roll over their pre-tax retirement dollars into the plan like a traditional or SEP IRA, and they can contribute a lot more to it, as I mentioned earlier, than an IRA. A couple of features here. There's a Roth feature to the 401k plan. So you can have two buckets of funds in the 401k plan, a Roth fund and pre-tax funds combined in there. Some big highlights here. You can loan yourself money as a plan participant of a 401k plan up to $50,000. And if you're getting a loan buying real estate, like Jason's going to talk about, and you use that leverage, you're not going to have to worry about that tax that I discussed earlier. Again, I can go into more detail with people offline here, but how the contributions work, you as the employee can defer up to $18,000 a year. If you're over 50, that number goes all the way up to $24,000. And those funds can go in on a pre-tax basis or in an after-tax basis, so the Roth feature of it. And then you make what's called the profit sharing contribution, and that's up to 25% of what you W-2 yourself or 20% of your adjusted gross income if you're a sole proprietorship or LLC. The combination of the employee deferral and the profit sharing contribution is $54,000 a year. Unless you're over 50 with that extra $6,000 in the employee deferral, that can go up to $60,000. So the 401k plan can directly hold the investment itself. So we get a unique EIN number for the plan, and you can have a trust account at a bank or a brokerage house to do investments. I have one of these myself. I just have a bank account through my local bank here, and I personally do some trust deed investments, but a lot of my clients do this for real estate investments, so they don't have to go to this custodian every time they need to make a bill, pay a bill, all that type of stuff. But you don't have to create the corporation for it. You can do it yourself, but we can get that set up and you can invest directly through the 401k plan and there's no even annual fees to that plan. So again, thank you guys for listening to my side of the presentation. Best way to reach me, brian@independenceira.com, or call me at 619-432-4555. And from there, I'm going to move this over to Jason. Jason, are you there?
Yes, I am. Thanks, Brian.
All right.
All right. And can you see the screen yet?
I definitely can.
All right, perfect. Well, hello, everybody. I am Jason Zook, and I am with North American Savings Bank and IRAlending.com. We were the first bank to offer a non-recourse loan nationally for the purchase or cash out on self-directed retirement accounts. So if you're looking to purchase property and possibly looking to leverage it, this is the right place to be.
Yeah, Dave, what's a good email for you? And I'll shoot you over a whole bunch more info.
All right. Today we'll look at the advantages of using the debt financing to buy real estate within the IRA. We'll answer some questions on how you can get the non-recourse loan to buy real estate inside the IRA, and also what the guidelines and parameters for a non-recourse loan through our bank, North American Savings Bank, is. After the presentation, if you would like, I'll have my email address on the very end of it, and you can email me. I'll be happy to send you a free copy of our ebook. We did write the book on leveraging your IRA. There's a second edition now, and I'd be happy to send you over some information along with a free copy of that book. So if you don't have enough money in your self-directed IRA to buy a property or the property you would like, or let's say you want a bigger property, or you want to buy multiple properties, this is where a non-recourse loan could come in to help leverage your purchase. And basically what the non-recourse loan means is that there is no recourse against you, there is no recourse against the IRA, only the property itself. So as a bank, we are not looking at you to qualify for the mortgage, we're looking at the property. The security instrument itself goes against just the home and not against you as an individual. In the event that your IRA stopped making the payments on the property, we could take back the property, but there still is no repercussions against you or the retirement account, only the property itself. So it would not affect your credit score. It would not affect you buying more properties, say through Fannie or Freddie and the limit that they have. So we'll get into what a non-recourse loan is. Basically, in the IRS publication 590, the IRS states that you cannot use your IRA as security for a loan. So that only leaves a non-recourse loan where your IRA is not used as security and the property is. North American Savings Bank has been around since 1927. We're out of the Kansas City, Missouri area. And beyond the IRA, we offer many traditional type of conventional loans as well. We do have over $1.5 billion in assets, and this is just a small part of what we do, but the only thing that I do. So I've been doing this 12 years. I was here to start the first national non-recourse loan program, so I could pretty much answer about any question you have in the self-directed field, or at least point you to the right direction. Some of the advantages to using debt financing within the IRA are that all the net proceeds go back into the IRA. This allows for larger gains in your retirement account. If you have, $100,000 in your account and that allows you to buy one small $100,000 property, then that's okay with some people. But what if you could turn that $100,000 into $200,000 properties, or one bigger one by using that debt? You can diversify your retirement account with tangible assets such as real estate. We allow for townhomes, condos, multi-units, single-family homes. We do also have a commercial division if you are interested in that, although I myself only handle the residential side. So who is eligible to obtain a non-recourse loan? Anybody who has at least 30 to 40% in the retirement account. You could have that in the AccuPlan or American Estate account with Brian, whether it's you've moved it to a 401k or some other type of entity. We typically want to see about 30 to 40% down. 40% is more the norm, although we do make exceptions below 40% on newer single-family detached homes. As this slide mentions, 30 to 40% as we went over, the rest normally about 40% down. These are just guides. This is a very subjective loan. I can submit any proposal to the bank management, bank president, and they can look at it. We've had plenty of exceptions made on property. There's certain states that maybe we won't go over 60% of a loan in, but on the right property, we'll definitely consider it. Now, when you're purchasing the property, I know there may be some confusion up front on how everything should be titled. We'll help you with that. When you're using the AccuPlan and American Estate and IRA, we'll make sure that your contract is correct. We'll make sure that the title work and insurance is ordered correctly. So I know that can be a real drain on some people, and we'll make sure and take care of all that or hold your hand through it so you won't have to worry about that. That can be very confusing at times. So NASB will lend in all 50 states. Currently, there are little parts of New York that we're not interested in, but every other state, if you find a property that you're interested in, I would be happy to take a look at it with you, go over the scenario, the cost involved, say, okay, based upon this information, here's what we can lend and here are the exact terms. Typically, once you bring a property to us, I can get a loan decision for you within a few hours, even a few minutes. I'll then forward you over some information to review, and if you agree to move forward, it's about 30 to 35 days to close right now. Loan terms, programs that are available. We have multiple. There is a 5 and 10 year arm, which those are fixed for 5 years and 10 years, and then adjust annually after that. The typical term is anywhere from 20 to 25 years on the adjustable rate products. And then we also have some fixed options. We have the 10 year, the 15, and the 20 year. This is a commercial loan. It's commercial because we're lending to the entity. We're keeping it here in our portfolio. And those rates range anywhere from lower 5s all the way through about 6%. The loan rate is determined by how long you want the loan fixed for. And I'm happy to send you multiple options so you can take a look at those and see what works best for you. These are
Jason,
yes, please.
What's your most popular loan, or does it totally vary?
Yeah, good question. Good question. And I would say that varies because in some states like California, for instance, I'll talk to people and say, hey, a 10-year arm going out over 25 years may be your best bet because now your mortgage payment is lower because you're going out over 25 years, where a 20-year fixed loan is only amortized over 20. Because of that, your mortgage payment is a little more increased, and maybe you can't get as much of a loan in certain areas. But 20-year fixed option is definitely our most popular product. People still want to feel the safe of the fixed. However, I would say look at your investment strategy. If you're only going to keep the property 7, 8, 9, 10 years, look at some other options so you're not paying the higher interest rate for that longest fixed term.
Oh, thank you.
Yeah, good question. These are each principal and interest payments. Beyond that, we will escrow for your taxes and insurance just like most traditional mortgages do. So we'll take care of that for you in your payment as well. We do have a minimum loan size of $50,000, and since we typically loan 30 to 40%, we require a minimum 30 to 40% down. You can see that would make your minimum purchase price normally about 80 to 85,000 is where we want to see, but once again, we'll make exceptions for other property. If you already own a property through your retirement account and you want to come back and get some of the equity out of it, we also offer the cash out refinance, where it's the same terms, same type of loan process. We'll take a look at the property, and about 30 days later, we'll just deposit the money back into your retirement account. This can also be used for if, let's say, you find a property that you're interested in and you have to close it early due to time constraints. You can buy it outright in the account and then come back and do the cash out afterwards to free up some of that equity again. I had previously gone over this. The properties that we are interested in are more residential, single-family, townhome, condos, duplexes, multifamily. I'll be happy to take a look at anything for you, or if I can't place you, I do have some other companies that we may be able to get you involved with, so feel free to ask me any questions on that. The properties that we do not lend on are more rural, raw land, farms, or things that aren't warrantable. For us, our only recourse being the home itself, we look at it as if we had to take this property back, could we get rid of it quickly? So that's kind of where we are on that. The income requirements on the property. We're going to ask you what the market rents are up front. If you decide to proceed, we actually have an appraiser perform the sales and rental comparables, and we normally want to see the property cash flow by 20 to 25% more than the expenses. We do make exceptions to that, especially if you're choosing lower amortizing period loans like a 10-year fixed or a 15-year fixed. We understand it may not cash flow where our requirements are, but that one may work best for you. Here's an example on the income and expenses and how to get the debt service coverage ratio, the DSCR. Assume you find a property that you're interested in that's $180,000. Rental income is $1,600 a month. What we're doing is we are annualizing that for a total of $19,200. And then taking out the expenses, estimated vacancy, your taxes, your insurance, and then a few other estimated factors such as maintenance, repair, and a 6% management fee. That may not be exactly how yours is, but we do have to use some kind of template for us to come up with some income and expense operations, and this is how we do that. So here you're coming out of a $19,200 rental income per year. Your net operating income is $14,064. And then what we'll do is we'll divide that by your mortgage payment to find out what your cash flow is. 1.0 equals a break even. We require 1.2 to 1.25 in most cases. On this one, you can see once you take out the expenses and divide by the mortgage payment, we are at a 1.61 or a 61% positive cash flow based upon our analysis. As mentioned, you may have your own way to analyze it. This is how we do it, and we do make exceptions to about anything, so you can definitely take a look at that. Some of the costs involved, NASB will charge a 1% origination fee on your loan amount, not the purchase price, and then $695 total in processing and underwriting costs. Those are the bank fees involved. Those are pretty standard. Beyond that are your other typical fees like an appraisal, your taxes and insurance, and title company costs. These are other costs that you really can't get around. So the only one for the bank is that 1% plus $695. Some of the documentation that we require would be a loan application, driver's license, purchase contract, appraisal money, and then if you had some 401k, we would ask for the documents on that to review the plan. But since we're not looking at you to qualify, once again, your income, your assets, your employment, none of that comes into play in this. It makes it a no document loan, much easier than a conventional loan in that regard. So feel free to check out our blog, visit our website at iralending.com, or you can call me or email me, as I mentioned at the beginning. If you'd like to shoot me an email, do so. I'll be happy to send you a free copy of the book as well as the current loan terms. You can also talk to me or one of our other representatives at the number here. It's 866-735-6272. And with that, thank you for having me, Brian, and I'll stick around if there's any questions.
No, well, thank you very much. That was quick but very informative there, Jason. We have one question from you here. And again, if anybody has any questions, please write them in the question section, and I'll be able to read these. And this first one here is from, who's it from? I think it was Nico or something. And asked Jason, I have a question about, the negative aspect of a self-directed IRA investment. What if the real estate property cannot be rented anymore and cannot be sold? Is there a way to write off lost money?
Yeah, good question. For us up front on the loan, we're looking at the entire scenario, and we also require you to show some reserves in the account. It doesn't all have to be in the self-directed, just some type of retirement account bearing your name. So we know in the event of not having a renter in there, you got plenty of months mortgage payments there where you can make those. Now, after we close, we're not going to look at your account again. So if you run that to zero, that's totally up to you. And if now you can't pay the mortgage, we can come back and take the property. We'll do our best to work with you to try to make it so that doesn't happen. But that's how we look at the loan up front is, 30 to 40% down. Is the property going to cash flow? So, if the renter is in there, you're making money. And do you have reserves so you can make those payments if you don't have a renter? As far as writing anything off, it'd just be speculation on my part, so I wouldn't want to do that. I don't believe so, but I don't know for sure.
Yeah, it'd be hard to write off taxes in a tax-exempt, tax-deferred vehicle in regards to the IRA there. One more thing came up here, looks like from Preston, if I'm reading it right. It's kind of in some small print. I talked to Jason before about turnkey. Could you talk about LTV based on previous sale price?
Yeah, no, exactly. Turnkey does change things a little bit. If the property has sold recently for less, many times we're not going to allow our loan amount to be anywhere near where that property recently sold for. These are the properties that we had to take back first in the decline. And so for us, to give you an example, let's say that somebody recently bought a property for $80,000. They put 20 into it and are now selling it to you for 120. Typically, our loan amount is going to be about 50% of your price. So about 60,000 might be able to get you up to 65,000, but we're not going to go near the 80,000 that the property recently sold for. There's always exceptions to that. You know, if we're talking about real large dollar property and large renovations, that may be a little different than, you know, an older, smaller home that's been renovated. But I'd bank on about 45 to 50% down on most turnkeys.
Let me see here. Hold on, I got another one. You mentioned a tax liability. This is from Marcos. You mentioned a tax liability on the net proceeds. Does that mean rent less expenses, including mortgage payments? And I have to pay 30% taxes on that, even if it's in the self-directed IRA. And Marcos, this is going back to the tax, the unrelated debt financed income tax. So
yeah. Big misnomer out there on that unrelated business income tax. I've been doing this for a dozen years. I've done thousands of loans. I've not had anybody come back to me and tell me they had to pay that. I'm not saying anybody hasn't, but if you are a passive investor where you're just collecting rental income, and that tax is based off your profits, you can still line item depreciation, taxes, insurance. Most people can make that into a loss, you know, just like you can on, you know, per year on how much depreciation expense that they allow you to do, your taxes, your insurance. That all leads into your profits. If there's anything left after all that, the IRS still allows you to deduct a certain dollar amount before they'll put a tax hit on what's left over profits. So I would, looking at it from me, and I own 2 houses myself, it's either going to be very negligible tax consequence or not at all. And as I mentioned, I've had nobody come back to me and say it actually affected them. I was told by a gentleman who does this a lot, that if you are a property flipper where you're having a business in your IRA where you're flipping multiple properties a year, that's where you're really going to look at, you know, this tax possibly taking effect. But I would encourage you to contact your own tax representative, your own CPA. There is also a chapter in our book here, Chapter 6, that goes over the UBIT. So if you would like to read that, feel free to get a hold of me for a copy of the book.
And you answered that perfectly. Again, yeah, you can write off a lot more things than just the rent and the mortgage payments there. And especially early on in these transactions, you know, you're not seeing too many people having to pay it. And if so, it's very minor.
Exactly.
But again, just as Jason said, consult with your tax professional before getting in, just to see what you guys think on the subject, and then we can get from there. Let me see. Question, or kind of a follow-up to that. Jason, this is for you. Do you guide anybody, I guess it's for both of us, to any specific tax professionals for that? Or do you just kind of say, yeah, you should consult with your own tax professional? I generally tell clients myself to consult with their own tax professional. I don't have anybody specific for anybody, but I guess, Jason, I'll see if, do you guys have any personal references for that?
No, same answer on my side. I don't have anybody specific. I do have some materials about the UBIT and the UDFI. I'm happy to share those materials with you, but I don't have a go-to guy or anybody that specifically can help you with that. I would encourage you just to contact somebody that you're comfortable with in your area on that.
All right. So if anybody has any more questions, please get them in here real quick. Otherwise, what we'll do is we'll wrap up here. I want to make sure everybody has Jason's contact information here. His phone number on the screen, 866-735-6272, or jzook@nasb.com. Or people can email me, Brian@independentira.com, or briandavis@ acuplan.net. Either of those will get to me, or my office line, 619-432-4555. Again, we're recording this, so hopefully we'll have the recordings out to you folks that signed up for the webinar, and you'll be able to watch later. But from there, Jason, do you have anything closing you'd like to say?
No, thanks for having me, Brian. I appreciate it once again, and I hope to do another one of these in the future. And if I can be of any assistance, please let me know.
No, I appreciate it, Jason. Yeah, Jason I've worked with for a number of years with different clients, and very happy that we're doing this together. Very informative for a lot of people out there that do have a lot of questions on this specific topic, and great to hear the answers to some of these questions. And thank you very much, Jason. Thank you, everybody who showed up today, took the time out of their day. Feel free to contact us with any questions. Thanks, everybody.